Preparing for a financial advisor at Bank of America Merrill interview. You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial advisor at Bank of America Merrill? Bank of America Merrill appeals to me because it combines Merrill's advisor-led wealth management culture with Bank of America's banking, lending, and digital capabilities. For clients, that needs advice can connect investments, cash management, credit, retirement, and estate planning in one coordinated relationship. I also like the firm's emphasis on goals-based advice and compliance. As a new advisor, I'd value the platform, training, and brand credibility, while still being accountable for building long-term client trust. While answering, focus on Merrill's advisory culture, Bank of America ecosystem, goals-based planning, training, brand trust, and why the platform helps you serve clients rather than just advance your own career. Question 2. What does a financial advisor actually do for clients? A financial advisor's job is to turn a client's goals into an actionable plan that starts with discovery, family situation, income, assets, liabilities, risk tolerance, time horizon, taxes, and priorities. Then I'd recommend suitable strategies across investments, retirement, lending, and protection, monitor progress, and communicate during life or market changes. The best advisors are not product pushers. They are relationship managers who combine technical advice, empathy, discipline, and ethical judgment. Make sure to cover discovery, planning, investment recommendations, risk management, relationship management, and ongoing monitoring. Show that you understand the role as advisory and fiduciary-minded, not simply sales-oriented. Question 3. How would you build your book of business in your first year? In year 1, I would treat business development like a disciplined pipeline, not random networking. I'd define a target niche, build a daily activity plan, track calls, meetings, follow-ups, and referrals, and use educational conversations rather than hard selling. I'd also leverage warm centers of influence like CPAs, attorneys, alumni, and community groups. My goal would be consistent, qualified conversations, because trust and conversion come from repeated, professional follow-up. In your answer, talk about disciplined prospecting, target markets, centers of influence, referrals, activity metrics, follow-up, and relationship building. Avoid sounding like you will rely only on friends and family. Question 4. How would you explain goals-based wealth management to a prospective client? Goals-based wealth management starts with the client's purpose, not a benchmark. Instead of only asking how much return they want, I'd identify specific goals like retirement income, college funding, home purchase, philanthropy, or liquidity for a business sale. Each goal can have its own time horizon, risk level, and funding strategy. That approach makes recommendations more personal and makes market volatility easier to discuss because performance is tied to real-life objectives. Be sure to mention client goals, time horizons, risk segmentation, funding needs, and linking investment strategy to life outcomes. Tie the concept to Merrill's planning-oriented advisory approach. Question 5. A client calls during a market sell-off and wants to liquidate the portfolio. What do you do? When a client wants to sell during volatility, I would first acknowledge the emotion rather than dismiss it. Then I'd revisit their plan, time horizon, liquidity needs, and asset allocation. If nothing fundamental has changed, selling everything may lock in losses and damage long-term goals. I'd discuss rebalancing, tax loss harvesting, or raising modest cash if needed. The key is calm communication. Protect the relationship while keeping decisions aligned with the plan. While answering, focus on empathy first, then planning discipline, liquidity needs, risk tolerance, rebalancing, tax opportunities, and avoiding emotional decisions. Show calm communication under pressure. Question 6. What is the difference between risk tolerance and risk capacity? Risk tolerance is how much volatility a client emotionally can handle. Risk capacity is how much risk their financial situation can support. A young professional with stable income may have high capacity even if they feel conservative. A retiree drawing income may have lower capacity despite being comfortable with markets. I would evaluate both through discussion, documents, and scenarios. Then recommend the lower risk boundary when there is a conflict. Make sure to distinguish emotional willingness from financial ability to take risk. Include examples, time horizon, income stability, liquidity needs, and how conflicts between the two should affect recommendations. Question 7. Walk me through how you would run a first discovery meeting with a new client. I would run discovery as a conversation, not an interrogation. I'd start with open-ended questions about what matters most, then move into income, expenses, assets, liabilities, tax situation, family obligations, existing advisors, and decision-making style. I'd listen for emotional drivers like security, legacy, independence, or fear of loss. Before recommending anything, I'd summarize what I heard and confirm priorities, because accuracy in discovery drives suitability. In your answer, talk about open-ended questions, financial facts, family context, emotional goals, existing advisors, decision-making style, and summarizing priorities before recommending any product or strategy. Question 8. How would you think about asset allocation for a recently retired client? For a retiree, I'd first separate income needs from growth objectives. The portfolio might include cash for near-term spending, high-quality fixed income for stability, and diversified equities for inflation protection and longevity risk. I'd consider Social Security, pensions, required minimum distributions, taxes, healthcare costs, and estate goals. I would not use a generic 60-40 answer without context. The allocation should support sustainable withdrawals and help the client stay invested. Be sure to cover income needs, liquidity, inflation risk, longevity risk, fixed income quality, equity exposure, taxes, withdrawals, and why the answer depends on the client's full financial picture. Question 9. What do suitability and regulation best interest mean in this role? Suitability means a recommendation must fit the client's profile. Regulation best interest raises the standard for broker-dealers by requiring recommendations to be in the retail client's best interest and not place the firm's interests ahead of the client's. Practically, I document objectives, risk tolerance, costs, alternatives, conflicts, and rationale. Compliance is not just paperwork. It protects clients, the advisor, and the franchise. At Merrill, that discipline is central to trust. While answering, focus on client profile, best interest standard, documentation, conflicts of interest, cost considerations, reasonable alternatives, and why compliance protects both clients and the Merrill franchise. Question 10. How would you explain fee-based versus commission-based accounts to a client? Fee-based accounts usually charge an advisory fee based on assets under management, which can align with ongoing advice, monitoring, and planning. Commission-based accounts compensate the advisor when transactions occur, which may fit clients who trade infrequently or need limited advice. Neither structure is automatically better. I would explain costs, services, conflicts, and expected activity clearly, then recommend the model that best matches the client's needs and usage. Make sure to cover compensation structure, ongoing advice, transaction frequency, conflicts, transparency, client fit, and why neither model is universally right. Keep the explanation plain English and balanced. Question 11. What would you do if a client insisted on buying an investment you believed was unsuitable? If a client wanted an unsuitable investment, I would slow the conversation down and understand their motivation. Maybe they heard a tip, want quick returns, or misunderstand the risk. I'd explain why it does not fit their objectives, concentration limits, liquidity needs, or risk tolerance, and offer a better alternative. If they still insisted, I would follow firm policy, document the discussion, involve supervision if needed, and be willing to decline the transaction. In your answer, talk about understanding motivation, explaining risks, offering alternatives, documenting the discussion, following firm policy, escalating when appropriate, and being willing to protect the client relationship ethically. Question 12. How would you leverage Bank of America's broader platform as a Merrill Financial Advisor? Bank of America's platform is valuable because wealth clients often need more than investments. A business owner may need treasury services, credit, mortgage planning, or liquidity management alongside portfolio advice. I would use those capabilities only after understanding the client's goals, not as a product checklist. The opportunity is to create a coordinated relationship where banking and investing support the same plan while respecting suitability, privacy, and client consent. Be sure to mention banking, credit, cash management, mortgages, business owner needs, specialist collaboration, client consent, and the importance of integrating solutions around goals rather than pushing products. Question 13. Tell me about a time you dealt with rejection in a sales or client-facing situation. In sales, rejection is data, not a personal verdict. If a prospect declines, I'd ask permission to understand why, record the objection, and determine whether it is timing, trust, value, or fit. I'd maintain professionalism and follow up with useful information when appropriate. The key is consistency. A financial advisor needs resilience because many relationships take months or years before a prospect is ready to engage. While answering, focus on resilience, learning from objections, maintaining professionalism, tracking follow-up, and improving your approach. Use a concise star structure and connect it to advisor prospecting. Question 14. How would you ask an existing client for referrals without sounding pushy? I would ask for referrals after delivering value, not randomly. For example, after helping a client organize retirement income or navigate a tax-sensitive event, I'd say that I'm looking to work with people facing similar decisions and ask if anyone comes to mind. I'd make the request specific, respectful, and easy. I would never pressure the client. Make sure to cover timing, earn trust, specificity, professionalism, client comfort, and focusing on people with similar needs. Avoid sounding transactional or desperate for introductions. Question 15. What is your current market view, and how would it affect client portfolios? I would give a balanced market view rather than make bold predictions. I'd discuss inflation, rates, earnings, valuation, credit conditions, and geopolitical risks, then connect that view to portfolio construction. In the current environment, I'd emphasize diversification, quality balance sheets, adequate liquidity, and rebalancing discipline. I would also separate short-term uncertainty from long-term planning. Clients do not need perfect forecasts. They need a portfolio resilient across scenarios. In your answer, talk about macro drivers, rates, inflation, earnings, valuation, diversification, risk management, and avoiding overconfident predictions. Link the view to portfolio positioning, not market timing. Question 16. How would you approach a high-net-worth business owner as a prospect? With a business owner, I would start by understanding both the company and the household balance sheet. Key topics include cash flow, succession, concentrated wealth, insurance, retirement plans, lending needs, tax exposure, and eventual exit planning. I'd avoid pitching immediately. Instead, I'd identify one or two high-impact issues, such as excess idle cash or lack of diversification, and offer a follow-up planning conversation with relevant Merrill and Bank of America specialists. Be sure to mention understanding business and personal balance sheets, succession, liquidity, concentrated wealth, lending, tax issues, retirement plans, and using specialists. Show consultative selling, not product pitching. Question 17. How do you cross-sell banking or lending solutions without damaging client trust? Cross-selling should feel like problem-solving, not pushing. If discovery shows a client has excess cash, mortgage needs, business liquidity, or estate planning concerns, I can introduce relevant Bank of America or Merrill resources. I would explain why the introduction matters, what value it may create, and let the client decide. Done correctly, cross-selling deepens trust because the advisor is coordinating solutions around the client's full financial life. While answering, focus on needs-based discovery, relevance, transparency, client choice, coordination with specialists, and avoiding product pressure. Make clear that cross-selling should improve the client's financial plan. Question 18. How would you measure your success as a financial advisor? I would measure success through both activity and outcomes. Early on, I'd track prospecting calls, meetings, discovery conversations, financial plans delivered, follow-ups, referrals, and assets gathered. Over time, client retention, wallet share, plan progress, risk-adjusted performance, and compliance quality matter more. Revenue is important, but sustainable revenue comes from trust, disciplined process, and doing the right thing for clients consistently. Make sure to balance activity metrics, asset growth, revenue, client retention, referrals, plan implementation, compliance, and client outcomes. Show that you understand both short-term production and long-term franchise value. Question 19. Describe how you would handle conflict within an advisory team. On an advisory team, conflict usually comes from unclear roles, communication gaps, or different client service styles. I would address it directly and professionally. Clarify the client objective, listen to the other person's reasoning, and agree on responsibilities and next steps. If needed, I'd involve the team lead early rather than let tension affect service. In wealth management, internal alignment matters because clients experience the team as one brand. In your answer, talk about client-first decision-making, role clarity, active listening, professional escalation, accountability, and protecting the client experience. Merrill interviews often value teamwork and maturity. Question 20. Why should we hire you for this financial advisor role? You should hire me because I understand this role requires both relationship building and technical discipline. I'm comfortable prospecting, listening deeply, explaining financial concepts clearly, and following a structured process. I also respect that Merrill's brand depends on trust, compliance, and long-term client outcomes. I'm not looking for a quick sales job. I'm looking to build a serious advisory career where activity, ethics, and client service compound over time. Be sure to combine motivation, prospecting discipline, client empathy, ethics, communication skills, learning mindset, and commitment to building a long-term advisory career at Bank of America Merrill. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.